My name is Amber Wilson and I am a member of the Cost Analysis Department tasked with making a presentation explaining my recommendation on Oil Company X. Oil Company X is a large oil refinery which has been expanding and taking on new investment projects. Recently, they have considered building a pipeline that stretches across the United States from Canada to New Orleans. This particular process will generate high revenues but also high costs. The expected profit generated from the initial investment after 10 years will be approximately 8%. Assuming that stocks tend to average a return of approximately 10% over a 10-year period, this would be the investment versus building. Recently, the CEO of Oil Company X has faced backlash from the company board, who have asked specific questions concerning the recommendations put forth by the Cost Analysis Department. The Cost Analysis Department has indicated that the marginal analysis does not support the project. However, the board feels that this would be a profitable project due to the massive revenues that would be quote-unquote generated. They have questions in relation to marginal analysis and how it is undertaken. As a cost analyst, I have been asked to make a presentation to the board explaining marginal analysis as it relates to opportunity costs, marginal costs, and marginal benefits, and how these three things factor into the overall decision of investing within the proposed pipeline and/or stock. Per Brander and Perloff, the opportunity cost of a resource is the value of the best alternative use of that resource. For example, if a firm purchases an input in a market and uses that input immediately, the input's opportunity cost is the amount the firm pays for it, or the market price. Roberts states that opportunity cost is a forward-looking concept, meaning it is independent of any previous investments or decisions within the company. This pipeline success cannot be defined by any other successes and/or failures incurred within Oil Company X. All that can be considered is the decision to invest with the factors at play, meaning we can only consider the return on investment of 8% over 10 years, and possibly the stock return of 10% over the same 10-year period. Opportunity cost here is the decision to invest versus not investing. The return on investment would be the overall opportunity cost lost or gained from the stock investment. The main cost here is the possibility that the stock will not return the 10% over 10 years, thus making the investment in stock possibly a poor investment. The investment in stock versus building the pipeline could also mean that because of the stock buy or the investment in the building of the pipeline, the company cannot invest in other large value projects for about 10 years due to the high capital being tied up in stock and/or the pipeline. Per Rasmussen in Module 1 of Managerial Economics, marginal cost refers to the cost to produce that additional unit. According to Cam Merritt at Schron, typically, marginal costs start out high and decline as you increase production, as overhead gets spread out over more units and you get unused capacity to work at relatively low cost. At some point, though, marginal cost bottoms out. You reach full capacity. And if you want to increase production, you'll have to buy more supplies, hire more workers, keep longer hours, and so on. That adds cost. So your marginal costs begin to rise. Now marginal cost is going to keep going up, while marginal revenue is going to start to decline, for reasons already discussed, meaning you're making less and less profit on each additional unit. In addition, there's the cost of degrading the environment by disturbing current ecosystems in place. Heavy machinery will produce loud noise in the surrounding areas and most likely produce smoke and pollution in the area at which the pipeline is being built. The stock investment remains at a projected return of 10% over a 10-year period. But what if? What if the economy turns south and the economy destabilizes? Are we overdue for a recession? So it would be more than likely that the next 10 years, the stock value we would invest in would be less than what we bought it for, meaning a return would be significantly less than intended. There is also the lack of portfolio diversification. By investing such a huge amount of money in one market, there is a huge risk of not having a significant payoff. There is also risk because we have too many eggs in one basket, so to speak. Marginal benefit. Per Rasmussen in Module 1 of Managerial Economics, marginal benefit is the additional benefit derived from producing one more unit of a good or service. The benefit from this investment could mean greater than expected returns. What if the economy is actually on the upswing instead of a downturn? We could invest in building our pipeline, and instead of gaining 8% back over a 10-year span, we could end up doubling or tripling that amount. In addition, this pipeline could be great for the surrounding communities. This building of the pipeline would require additional workers in each area, spanning several areas of expertise, meaning booms of employment for the surrounding area, which also means booms of economic spending in possible areas of hospitality and healthcare. This pipeline expansion could help out its surrounding areas, as well as helping our company maximize its bottom line. Investing in stocks could prove less risky over time than building the pipeline. Building can cost lots of time and money and is not a sure thing. While stocks are not always sure, it's less of a risk because one could sell at any time. Stocks also have the potential to produce greater returns than expected. Instead of seeing 10% come back, we could double or triple that number by basically sitting back and doing nothing while the returns create themselves. In summary, Oil Company X is considering investing in building a pipeline, or using this money potentially to invest in stocks. Using marginal analysis, we have evaluated the opportunity costs, marginal costs, and marginal benefits, and how this relates to our overall recommendation. Our recommendation here is to pass on building the pipeline. The board feels this would generate massive revenue, but the costs here outweigh the benefits. The pipeline would be a huge investment, thus preventing any other large investments over a 10-year span, thus limiting the potential expansion of the company, Oil Company X. It would negatively impact the environment surrounding the pipeline and disturb the surrounding communities with unnecessary noise and pollution. The less risky alternative here is to possibly invest in stocks. It is something that can be bought or traded at any time, can be significantly increased in value, and requires very little time or effort on behalf of the company. My name is Amber Wilson, and this is my recommendation on Oil Company X. Again, do not build the pipeline, perhaps invest in stock. Thank you. For more information, my resources can be found here. Thank you very much.